The Fed's preferred inflation gauge, the June PCE index, rose 2.5% from a year ago, in line with estimates. Will signs of slowing inflation pull up the Fed's rate cut timeline? Well, joining us now is David Mericle. He is the chief U.S. economist at Goldman Sachs. It's great to have you on the show. Welcome. Let's start right there with the inflation print we got this morning. It was in line with expectations. In the market, there seems to be an expectation that we're going to get a cut in September. But this week alone, we've seen more chatter about the argument materializing that the Fed should consider cutting next week. Where do you fall on that?
I'm sympathetic to that. I don't think that they will. I think what they'll use the meeting for next week is to tweak their statement to imply that a cut is closer at hand. I don't think they'll say it's definitively coming at the September meeting. I would expect that they'll want to wait until we see the July inflation data. But as long as the July inflation data are acceptable, at that point, they'll indicate to us that, yes, they are going to go ahead in September. I don't think it makes a huge amount of difference, but I would say, to my mind, the inflation story has been pretty convincing for a while. We had rebalanced the labor market, normalized inflation expectations already by the end of last year. There have been some ups and downs this year, but there's always noise in the inflation data. I think there are also some seasonality problems, and maybe we've been overreacting a little bit to those month-to-month up and downs. But I assume most of the committee is now pretty close to being content that it's okay to go ahead.
Yeah, the Fed has a dual mandate, and up until recently, there hasn't been much focus, at least publicly in commentary we've been getting from officials about that mandate. That seems to have shifted in recent weeks as we've started to see softer labor market data come in. We also know labor market data tends to be one of the last indicators that the economy is slowing or that we're rolling over into a recession. Historically, that's been the case. You've written about it, but why is this time different?
I would describe the labor market data as mixed. I wouldn't describe them as weakening. We did just have a quarter where GDP grew at a 2.8% pace. The last couple of payrolls reports have been north of 200,000. My guess is going forward, we'll only need about 150,000 jobs a month in order to stabilize the unemployment rate. So my base case would be that everything will be fine. I do think it's fair to say, though, that the signals are mixed. For example, the household employment numbers, even after adjusting for the fact that they're undercounting the immigration boom, they're still weaker than the payrolls numbers. The unemployment rate is up almost half a point on a 3-month average basis. So, I think it would be fair to say, even if your base case is that everything will kind of work out naturally, because if final demand is growing at a good pace, labor demand should too. I'm not at all really worried about the inflation outlook. So I would say if they're going to cut, yeah, just get on with it. But, again, I don't think they're going to do that next week. I do think they'll do that by September, though.
OK, we do get this jobs report next week as well, and all of that labor data. How much does that matter? Does it matter more now?
I think it matters more just because how you're supposed to read these mixed signals is a little bit unclear at the moment. I think the historical lesson is put a lot more weight on the payrolls numbers, which are a lot less noisy, a lot more reliable. But the gap between household employment growth and payroll growth, even after all of the kind of definitional differences and the undercounting of immigration in the household survey, it's still big enough to be a little bit striking and a little confusing. So maybe we'll get an employment report that will resolve some of those gaps and clear things up a little bit. But yeah, I do think, given the upward trend in the unemployment rate in particular, this one will probably get a bit more attention and should get a bit more attention than your typical report.